Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Brian Joyce, who's the Managing Director of Nasdaq's Market Intelligence Desk, to review the technicals on one of the most historic quarters in the markets. Brian, it's great to have you with me as always, and I'm sure many are happy to see the first quarter of 2020 come to a close.
Absolutely. It was certainly a historic quarter, dramatic price action, most of it to the downside. It remains to be seen how far or how long we'll have to, deal with this environment. Obviously, a lot depends on how long the virus stays with us. But given the tremendous amount of liquidity injections and asset purchases and the programs, the lending programs being put in place by, the four horsemen, Congress, Treasury, the Fed, and the regulators, I think when we come out the other side of this, there's certainly, I think, going to be better days ahead.
All right, let's take a look at our first chart here, and this is the S&P 500 on a weekly, so we have a little bit of a longer-term outlook here.
Yeah, so this is the chart. We've been looking at this for a couple of weeks, and what we're trying to see here is where can we expect this bounce to go, how far up. And the first line in the sand that we have been looking at is around that 2650 level, and there's a cluster of technical resistance that begins here. So first and foremost, the 38.2% Fibonacci retracement of the entire 1,200-point downtrend comes right in there at that yellow dash line, 2651. Secondly, the purple line that's running left to right across the screen, there's your 200-week moving average. That's just 5 points below at 2645. And then thirdly, not seen on this chart, but if you had a 30-minute period chart or a 60-minute and hourly chart, we could see that between 2630 and 2740, 2741 to be exact, so a pretty wide range there, but that was a price gap that was made back during the downtrend back on March 11th, March 12th. And so that cluster of technical resistance, the 2630 being the lower end of the gap, the 200-week, and the Fibonacci retracement, all kind of comes in around 2630, 2650. That's a key support level. That's where we stalled the last week. So we bottomed last week on the 23rd, down about 35% off the highs. It took 3 days to gain 21% from Monday's low to Thursday's high. So let's call it four trading sessions to rally back 21%. And then from last Thursday through, let's say, a day or two ago, we haven't been able to get above that 2650, 2640 range. And now we're beginning to roll over. We haven't pulled back that much, but it remains to be seen kind of where we go from here. Whether or not we could bust through 2650, it's certainly a possibility, but then I would just look to those other Fibonacci retracement levels, the 50% up at 2790, and even if we get further than that, the 61.8 up at 2934. Even if we get up to those levels, I still don't think this market is out of the woods yet. We could potentially see a rollover from there.
All right, let's take a look at our next chart here at the 2020 drawdown, and we're comparing the major averages here, clearly the Nasdaq 100 and the Nasdaq Comp, with less financial and energy exposure ahead of the pack here.
Right, so this is just a look at what, through the end of March, as of the end of the quarter, how the markets were shaping up. And so the Nasdaq 100 did fare best. It drew down 30%. And on the other end of the spectrum, we had the mid caps and the small caps losing 44 and 45%. And we previously noted a big reason for that is the Russell 2000 has its biggest weighting in financials. About 25% of the index is weighted to financials, which have taken it on the chin. One of the worst performing sectors, along with energy, and they're taking it on the chin so much is because they have big exposure, big sensitivity to interest rates, and we noted that the yield curve from the 1 month to 12 month at one point in March and at the end of March was all in negative territory. The Fed cut the overnight funds rate to zero, so the net interest margins are coming in quick, and those are an immediate hit to earnings on a quarterly basis. And then the expected loan growth is likely coming down as well as increased credit costs. So there's a lot of different headwinds there for financials, which make up the big weighting in the Russell 2000. And the Nasdaq 100 is a non-financial index. It's the 100 largest companies on the Nasdaq Stock Exchange, excluding financials. So, and thus it has a big weighting in technology, which has been doing relatively well.
Right, and we can see that our next chart here with the GIC sectors with financials and energy lagging to my point before, and what you had just said, that's why we're seeing the outperformance in the tech-heavy indexes, but you could see it here. I mean, financials and energy are significantly underperforming relative to the rest of the sectors.
Correct. So this is the 11 GIC sectors that make up the S&P 500. Staples and healthcare, as you would expect, are at the top of the list. Those are defensive groups. And at the bottom, financials and energy. Energy is not only suffering from the reduced demand that this global containment is having, resulting in, but also the fact that we have a price war between Russia and Saudi Arabia, and they're actually increasing supply as demand falls off. So it's a double whammy there for energy. Energy stocks by far taking the biggest hit here. Again, followed by financials and industrials. And really everything on an absolute basis is getting hit pretty hard, but on a relative basis, most of those defensives are doing well. REITs haven't been standing up as much as you normally would expect, but given the containment policies that are being instilled, a lot of REITs have exposure to malls and things like that.
All right, moving along to the dollar index, which actually was up for the quarter. One of the few bright spots that were up.
Yeah, so the dollar index is modestly higher for the quarter. This year is a long-term chart going back to the early 1990s, and typically, particularly since the Great Recession in 2008, 2009, the stronger dollar has not been a good correlation for risk assets. So when the dollar gets strong, that usually is a reflection of some sort of tension or some sort of concerns going on in the marketplace, and it's essentially a headwind for the rest of the globe. And I think that's why you saw the Fed step in and open up its dollar swap lines, expand them from 4 or 5 countries to 14 different countries. And just the other day, what they did was they even created some new repo lines, allowing countries that are not available or that are not in that group with access to the swap lines, allowing other countries that still have big treasury holdings to use those treasury holdings in repo operations. Essentially what's going on is overseas countries and corporations need access to dollars. They don't have enough access to dollars to pay to make their payments. A lot of their debt is dollar denominated as well. And so what they're doing is selling dollar denominated assets to raise cash. And that's kind of been adding fuel to this problem of negative price action. So what the Fed is doing is they're opening up swap lines to give certain countries direct access to U.S. dollars, and those companies that are not in that group can now use their securities like treasuries to put them up in exchange for cash. So put those treasuries as collateral and get cash back. And so that's why, and because the dollar is so strong, that's reflecting kind of that scenario.
Yeah, and if we take a look at our next chart here, WTI Crude, I mean, that really has been the other story in this market, which I think, regardless of COVID-19 and its global economic impact, crude would still be having issues despite the reduction in demand.
Right. So the crude here, we did have a spike today in crude. That was on news that Donald Trump he sent out a tweet essentially saying that we could expect to see 12 to 15 million barrels of oil come back onto the market if an agreement can be put in place between Saudi Arabia and Russia. I'm not sure how far along those talks are, if at all, but oil certainly had a positive reaction from that, and then it spiked higher, maybe from the inventory numbers that came out around 10:30. But we did see it today get up to around 27.40. That did mark an obvious pivot low back in early March, on March 9th, which I believe was the Monday when we came in, when Saudi Arabia had decided to go ahead and increase production. So that day on the 9th was a Monday, and oil at one point was down more than 33% on an intraday basis. It did rally back a little bit and cut that percentage maybe down to 20% or so, but that was the dramatic decline. But that intraday low was around 27.40. We saw again back on March 20th. You can see it on this chart. It then acted as resistance, and now today it marked the high as well. So oil is certainly far from being out of the woods. The range we essentially are seeing is roughly 19.5 to, let's say today's high, 27.5. It's certainly a wide range to look to, but until oil can get back above, let's say 27, 28, it certainly has a lot left to prove, and you could see some overhead supply be kicking in.
All right, and let's wrap it up here with the VIX. We have not seen this kind of volatility for quite some time in the markets.
Right. So this is more of a coincidence indicator when the volatility kicks in. You see extreme selling pressures across various asset classes, which we certainly have seen now in the month of March and into the month of April. The VIX spikes higher. It's a reflection of the premiums investors are willing to pay for calls and puts. And in mid-March, it hit an all-time high. This is a daily closing price, and we could see, based on daily closes in March, the VIX hit its highest level ever, even when we compare it to 2008, 2009, which is a pretty extreme period of time in this country. So we certainly are at historic times here, whether we're looking at the VIX, whether we're looking at the percentage drawdowns. I think it was last week we looked at the Dow had declined 38% from its high, from February high to March low. And we haven't seen declines like that except for 1987 and 1929. So truly historic times that we're in right now. And the VIX is just one other barometer that kind of shows that point.
All right, Brian, great stuff. Thanks so much for the quarterly recap.
All right, thank you.
All right, and thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.